Hey guys, what's good? I'm Andre and today I want to walk you guys through executing a poor man's covered call trade on SOFI. Before we jump in guys, I'm gonna plant one tree for every 20 likes this video gets. Help me out and we're gonna help the planet out as well. So guys, SOFI is currently at a support line that's pretty fantastic given the way it's been trading in the past few months here to a year. It's definitely at very strong support and I think it's the perfect time to potentially invest in SOFI for the long term. Now, my opinion is that in the fintech industry, it's one of the most important stocks that's up and coming and probably going to make quite a few waves in the future. That being said, of course, the recommendation is that if you have the portfolio power to buy 100 shares outstanding, do that. Don't do a poor man's covered call, just do regular 100 shares and then sell covered calls on that. But given the fact that the stock is at roughly $15 right now, it means that the leaps would be something that pretty much every single portfolio out there would be able to afford. And that is why I decided to build this video now. So let's jump right into just figuring out how we should go about things and what we should expect as an outcome from this. And then obviously I would like to walk you guys through how to actually execute it properly, because I've seen way too many YouTubers explain leaps wrong and way too many of them think that a leaps is just a call that expires in 3-6 months. That's not true. So let's start and I'm gonna try to sprinkle some wisdom here and there. Before we start though, please remember that in a couple of days now I'm gonna be launching that one portfolio that's gonna be a road to glory type thing, where we plan to take a portfolio that's gonna be anywhere between 3 to 5k and grow it throughout next year to hopefully beat the markets quite by a margin. So with that in mind, let's jump in here guys and have a look at this. Okay guys, cool. So the first thing I want to have a look here is just the chart the way we always do. First off, on the daily, if we have a look at SOFI, it's pretty clear that we have a support line here, right? We've touched it once, twice, 3 times here, 4 times, 5 times, and now the 6th time. It's definitely a support line. We can all vow for that. Now the next part that we want to have a look at is how does it actually look like on the weekly guys. And obviously we're gonna see the same support line. The one unfortunate thing about SOFI is that it's so early stage that we don't really have 100, 200 day moving averages when we're looking at the weekly chart, because it 1 or 200 week charts obviously, or moving averages. So with that in mind, of course, we're gonna have to sort of wing it a little. That being said guys, it's pretty clear that it found support so many times that we can't really ignore it, and from here we can see a potential upside of roughly 60% back to previous highs, not all-time highs, just previous highs. So guys, let's just have a look here at the potential to build a leaps and how that would actually look like. What do we want to look for? So first off guys, a leaps means long-term equity anticipation security. It's basically a call that you buy that expires in more than 1 year. It also needs to have a delta better than 0.6. So anybody that tells you that a leaps is anything other than what I have just described, ideally if you can get the delta to be at 0.7 or 0.8, that's even more better. But again, anybody that tries to tell you that it's something else than what I just described, call them out on it, they're wrong. So the next thing that I want to do here guys is obviously go out to January 2024 guys. So this would give us roughly 2 full years for us to be able to figure out what we're gonna do here. So with that in mind guys, let's go ahead and identify the strike price that we want. First off, we know the fact that we are at support, right? So that kind of allows us the flexibility or the luxury to not go that deep in the money when buying the call. So I would really just go for either the 12.5 strike price or go with the $15 strike price. And why do I say that? Well, you guys want to look at the delta. As long as we have a delta of, again, 0.6 or 0.7. Now for the 12.5 one, we have actually a 0.77 delta, which is really fantastic. It means that delta, as you well know, has 2 functions here. First off, it identifies the fact that our leaps, our option, will move by 0.77 of a dollar, so 77 cents for every dollar that the stock moves. And then the second part is that it tells us the fact that we're 77% likely to have this option expire in the money. So with that in mind, guys, with a 77% chance for this trade to be successful, I'm more than good with that. I want to buy this, so we're gonna go with the 12.5 one, and as you can see, the bid ask price is between $765 and $720. Now again, we're talking in 100 share iterations, so this would be $765 or $720. So how do we go about actually making that part of that money back so that we can afford to sort of fund this trade? And for these guys, I do want to move over here to a little online tool that's completely free to use, that's called Option Profit Calculator. I really find it extremely useful, and I'm gonna show you guys how to use it and why I think that the strike price is enough. So first off, we want to build the long call just so we can have a reference for it. So we're gonna buy the option that we just described. So we're gonna go over to January 2024 and then just buy the middle here between buy ask price of the 12.5 strike price. So guys, with that in mind, we now have a price per option of $735, and the total cost again would be $735. So if we go ahead and calculate that and just see what the risk would be, what the potential profit would be, and I don't want to go as low as $7.5 because I really don't think that SOFI anywhere in 2024 can be this low. So I'm just gonna go 13 to, let's say, $40, and let's recalculate it. So guys, we're gonna have an entry cost of $735, but TBD on this one, and then the maximum return is gonna be infinite. And I want to make sure that we're on profit and loss here, which we are. So as you guys can see, if by expiration we are at $13, we're gonna have the maximum loss here, but obviously we're not gonna do this, we're not gonna be in this position, and I'm gonna explain why. But potential upside right now, as calculated from the data that we plugged in so far, would be roughly at $2,000 if the stock would be at 40. So obviously if the stock shoots to the moon and ends up at $255 by expiration, this will change massively, but for the $40 that I set as sort of a ceiling, this is what it's showing us. And now if we have a look at the roughly $25 mark that SOFI has been at recently, we can see that we can make $500, which would roughly give us a 90% ROI on this trade. So guys, with that in mind, the next thing here is actually building up the poor man's covered call side of things. So we're gonna want to sell an option as well as buy an option. So we're also going to buy the call just like we did last time, the $12.5 call, and it's again gonna be $735. So far it's exactly the same, but what we're gonna do next is actually write a call. So sell an option, sell a covered call basically on your leaps instead of selling it on the 100 shares. And we're gonna go out to initially to January 21st, and then just identify, guys, the one thing I want to make sure that we do is not be too close, because if we get called away on this one call, I don't want us to be in a losing position. So let's just have another look here. We were paying $7.5 roughly on a $12.5 strike price. So 7.5 plus 12.5 equals roughly $20. So I'm gonna want to get pretty close to that. So I'm actually gonna probably sell the $18 one here, just because the money that we're gonna make back for it will allow us to have the entry cost a bit lower. And then again, for the price range, I'm gonna be between $12 and $30 or $40, sorry. So let's calculate and see how we stand. So first off, guys, we're gonna see that we are at 704, and then it now tells us that the maximum return is one of $242. And why is this? This is because this is getting calculated on an expiration of the 21st of January. This is the way the tool works. This is the way any tool out there works, because it calculates when the first option is gonna expire rather than when the second option will expire. So the first one will obviously expire in January of 2022, but the one that actually interests us will expire in January of 2024. So guys, let's pretend that the stock does end up at, what did we write this for, at $18. If it ends up at $18, guys, at expiration we're gonna make 200 bucks, and then obviously that's money in the pocket. You're making roughly 20% on a trade that took 1 month or 30 days. This is fantastic in my book. But the golden goose here is that the ideal is for us not to get called away. So whether we have to roll or whatever we have to do, the ideal is not to get called away, at least not immediately. Let's allow the stock time to raise a bit more. And then obviously we want to make sure that this one expires, ideally worthless if we can, and then we start writing new ones and new ones and new ones every single 2 weeks or month on the initial 12.5 leaps that we bought, guys. So with that in mind, we have now managed to deduct $31 from the initial cost of $735, and the goal here is definitely gonna be for us to continue building profits and premiums so that we can keep deducting from that initial cost of $735. Guys, I've done it before quite a few times where by expiration I have completely removed every single penny of this initial amount of money that I paid, and I really think that by 2024 basically you have 24 months, let's say 20 months worth of, let's say you only make $40 a month, that's $800, so you're already in the profits just by selling the covered calls. I'm not even taking into consideration the long option here and how much you're gonna be able to make on that long option. The last tip I want to leave you guys with is to always make sure that you're choosing the covered call delta or the covered call strike price according to delta. And what you're gonna want to do is have a delta of somewhere between 0.2 and 0.3. Basically you will say that you have a 20 to 30% chance of getting in the money and getting that leaps called away from you. So as you guys can see, the initial January 21st one that we had, strike price 18, was a delta of 0.25. This is roughly the sweet spot here. What I do like usually to do is just to go out in expiration a bit more. I think that the 21st of January is roughly 27 days away right now, and then obviously we have that theta ramp up happening between 45 and 30 days out, so I usually like to pick an expiration date that's exactly in that range. But for the poor exemplification, I just chose to go with this one this time, guys. That's all for today, guys. Hopefully the video has been useful. Let me know if you have any questions. I'll be more than happy to answer them, and I'll catch you next time. Take care.